Welcome to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Today, we're diving into the current landscape of the Canadian real estate market, where investors are increasingly opting to sell their properties as financial pressures mount. We'll be exploring the factors driving this trend and what it means for the future of real estate investment in Canada. Many Canadian investors, who once viewed real estate as a reliable and secure investment, are now confronting a harsh reality. Rising costs are outpacing the rental income they can generate, prompting a growing number of them to list their properties for sale. It's a situation that many landlords are finding difficult to navigate as they face tough decisions about whether to hold on to their investments or cut their losses and sell. Take, for instance, Bawalaya Isho, a 28-year-old car mechanic who purchased a two-bedroom condo in Barrie, Ontario, 2 years ago for $600,000. His goal was to build wealth through real estate, but the rising interest rates have pushed his mortgage payments well above the rent he collects. After months of losing money, Isho decided to sell the property for about $80,000 less than what he paid. Isho shared with Bloomberg, "I was in the red pretty deep, but I was trying to focus on, let's hold on to this place, and maybe in a couple of years I can make some money and flip it. I'm going to take my losses now and get out with whatever I can." His story is not unique, as many Canadian housing investors are feeling the financial squeeze. New listings are on the rise across the country, particularly among smaller landlords who are struggling to cover their costs. While it's unclear exactly how many of these listings are from investors, the difficulty in generating sufficient rental income to keep up with elevated mortgage payments is evident. In recent years, rental rates in Canada surged due to an influx of international students and immigrants, but this upward trend has now slowed. In some areas, like Toronto, rents are even starting to decline. According to rentals.ca, the average asking rent across all property types in Canada has been just below $2,200 per month this year, following significant growth in the previous years. Despite a slight decline in home values, the benchmark price of a home in September was $718,200, down 3.6% from the year before. Ownership remains unaffordable for many Canadians. Home prices are still 36% higher than they were 5 years ago, and elevated borrowing costs have slowed the market. Homes are lingering on the market longer than they were a few years ago, leaving investors uncertain about the future. RBC economist Rachel Battaglia noted, "The market outlook is not great for housing investors. We're expecting a very gradual increase in prices, which doesn't do much to entice them. Rents have not been increasing at the pace they have been." And some investors likely got burned the last few years as well. Investors now make up almost 1/3 of all mortgage purchases in Canada, yet many are finding it increasingly difficult to hold on to their properties as costs rise and rents stagnate. The tenants, it seems, hold more power in this market. Danielle Levy, a Toronto area real estate broker, is witnessing this firsthand as she works with renters looking for lower rent options. "The tenants really have the power," Levy explains. "Right now, people are trying to move out from those places from last year to get cheaper rents." This shift in tenant behavior is adding to the challenges faced by investors trying to exit the market. New listings have surpassed sales in many of Canada's major markets, making it harder to secure buyers. Condominiums, which have been a favorite among investors, are experiencing the sharpest rise in listings. Data from the Toronto Regional Real Estate Board shows that condo listings have grown faster over the past year than any other type of property. Compounding the issue, nearly 27,000 new condo units are expected to hit the market in Toronto this year, with even more anticipated next year. Most of these units were purchased by investors before construction began, when the market conditions were more favorable. Sean Hildebrand, president of real estate consultancy Urbanation, highlighted the situation. "Investors are looking to sell. You have all this supply coming in, most of it is investor-owned, and it's hitting the market all at once." RBC, Canada's largest bank, recently released a research note suggesting that the much-feared mortgage renewal cliff may not be as dire as originally anticipated. While many Canadians were concerned that the rapid rate hikes by the Bank of Canada would lead to significant financial strain upon mortgage renewal, RBC's findings indicate otherwise. The easing of policy rates has begun to alleviate some of these fears, with many households not expected to renew at the higher rates once predicted. The Bank of Canada had previously hiked rates at a rapid pace, soaring from 0.25% to 5.0% over just a couple of years. This led to widespread concern that homeowners who secured mortgages during a period of historically low rates would face a cliff when renewing at these elevated levels. However, RBC points out that the central bank has reversed its course, cutting rates by 0.75 percentage points in the past 4 months, bringing the current policy rate down to 4.25%. Experts anticipate further cuts by the end of the month, with projections suggesting an additional 0.5 percentage point reduction. These adjustments are expected to bring relief, particularly to those with variable rate mortgages, as they will likely see lower debt payments or reduced interest costs. It's important to note that fixed-rate mortgages, while not directly influenced by the central bank's cuts, are still affected by changes in government bond yields. Fortunately, these yields have also been on a downward trend, with the 5-year government bond yield dropping significantly. This has, in turn, reduced the cost of 5-year fixed-rate mortgages. The most significant impact, however, is being felt by borrowers with 1 to 3-year fixed-rate mortgages. The 2-year bond yields, which influence these shorter-term mortgages, have seen a substantial decrease, suggesting these borrowers might even renew at lower rates. Nathan Jansen, Assistant Chief Economist at RBC, explains that many variable rate mortgage holders are already experiencing some relief, either through lower payments or larger principal payments. Despite these positive developments, Jansen warns that households with 4 and 5-year fixed-rate mortgages could still experience some financial strain upon renewal. Nonetheless, the overall risk to the economy from mortgage renewals is now considered minimal. RBC's forecast suggests that the anticipated renewal cliff will have a negligible impact on the national economy, shedding just 0.1 percentage points from household disposable income. While the mortgage renewal risks have diminished, RBC highlights a more pressing concern: rising unemployment and a weakened labor market. Jansen's research indicates that a 1 percentage point increase in the unemployment rate could reduce household disposable income by 0.5%, which is significantly more impactful than the potential mortgage renewal shock. RBC's current forecast predicts that the unemployment rate could reach 7% by early 2025, which is over a percentage point higher than pre-pandemic levels. This potential rise in unemployment poses a much larger threat to household financial stability than previously anticipated mortgage renewal challenges. Job vacancies are a key factor in this equation, as they have declined by 25% from last year. Initially, there were more job vacancies than individuals seeking work, which cushioned the impact on the economy. However, with the unemployment rate now surpassing pre-pandemic levels and a decreased job vacancy rate, any further decline in hiring demand could exacerbate unemployment concerns. Today, let's discuss the significant barriers to homeownership in Canada, as highlighted by mortgage expert Ron Butler during his recent testimony before the Standing Committee on Finance. Butler painted a rather grim picture of the current real estate landscape, emphasizing that the dream of homeownership is slipping further out of reach for many Canadians, especially young people and those who lack substantial family support. During his address, Butler urged the government to address the deepening housing affordability crisis. He pointed to the expanding gap between Canadians who already own homes and those for whom homeownership remains an elusive goal, largely due to skyrocketing property prices and stagnant wage growth. Homeownership is no longer a reasonable middle-class expectation for young people, Butler stated, underscoring that many young Canadians now rely heavily on family cosigners or financial gifts to purchase property. Butler described this situation as a tragedy, noting that the days when middle-income earners could easily access the housing market are long gone. This is particularly true in major urban centers, although he did mention that opportunities still exist in some rural communities within the prairies in Atlantic Canada. Without co-signers or significant gifts for a down payment in major centers across Canada, there are no opportunities for people of a moderate income, he told the committee. According to recent data, the national average home price reached $674,400 as of September, marking a 2.3% increase from the previous year and a staggering 38% rise from 5 years ago. In provinces like Ontario and British Columbia, the average home price exceeds $1 million in cities such as Toronto and Vancouver, further exacerbating the affordability issue. Butler also expressed concerns over the government's new mortgage reforms, particularly critiquing the expanded Canada Mortgage and Housing Corporation program. He questioned the logic behind raising the insured mortgage cap to $1.5 million, deeming it excessive, especially when compared to the United States, where a similar program under the Federal Housing Administration has a cap of around $766,000 in high-cost areas. He highlighted the stark contrast, arguing that Canada does not have as many high-priced cities as the U.S., such as New York or San Francisco, and therefore should not require such a high cap. My constant refrain is that the price of houses in Canada, and certainly in Ontario, is just incredibly high. And measures that support a $1.5 million starter home have reasonably got to be called into question, Butler said. When asked by Member of Parliament Pat Kelly if raising the insured mortgage cap would assist young Canadians with housing affordability, Butler pointed out that the program's upper limit necessitates a household income of $352,000. There is no reasonable hope that this encompasses the average range of income, he commented, highlighting the disconnect between policy and the economic realities faced by many Canadians. In his testimony, Butler also voiced significant concerns about the future of Canada's housing supply. He warned of a potential freefall in housing construction over the next several years, particularly in high-demand regions like Ontario and British Columbia. Rising construction costs and declining new home sales, driven by affordability challenges, are contributing to this downturn. Developers are increasingly scaling back or canceling projects because they cannot sell enough pre-sale units to make these developments financially viable. We're going to reach a point in 4 years where the total number of new units constructed in the Greater Toronto Area will be 1,500, Butler predicted, illustrating the severity of the situation. The latest survey from EveryRate reveals that a significant number of prospective homebuyers in Canada are holding off on entering the market until the Bank of Canada lowers its policy rate below 3%. Currently, the rate stands at 4.25%, and nearly 3/4 of those surveyed, about 74%, indicated they'd consider buying or refinancing only if the rate drops below this threshold. Another 12% said they'd act when the rate falls below 4.0%, which could happen soon, while a mere 3% are ready to proceed regardless of the current rates. Andy Hill, a mortgage broker and co-founder of EveryRate.ca, shared insights on these findings, noting that Canadians are eager to enter the housing market, but are waiting for more favorable conditions. We knew Canadians wanted lower rates, we knew Canadians wanted into the housing market, we just didn't know how low they needed rates to go before they get off of the sidelines, Hill commented. This anticipation is set against a backdrop where fixed rates are not expected to dip below 3.0% until mid-2025, keeping many potential buyers and refinancers on the sidelines. The Bank of Canada's policy rate impacts the prime lending rate used by most lenders, which in turn affects variable mortgage rates. Currently, national discount brokerages offer variable mortgage rates around 5.40% for uninsured mortgages and 5.20% for default insured ones. Fixed rates, which are influenced by Government of Canada bond yields, have seen some decline over the past year. Recently, a few discount brokerages offered 5-year fixed rates just under 4%, but these were for high-ratio default-insured mortgages only. However, a recent spike in bond yields has led to the disappearance of these sub-4.0% rates. The national average for high-ratio 5-year fixed mortgages now stands at about 4.50%. Despite this, experts like Ron Butler of Butler Mortgage suggest that the recent spike in mortgage rates is likely temporary. As bond yields stabilize, rates are expected to resume their downward trend. In related news, Canadian household debt growth stalled in August, with total credit liabilities reaching $2.98 trillion. This was largely driven by real estate secured debt, including mortgages and home equity lines of credit. Meanwhile, active real estate listing cancellations have increased as some sellers await future rate cuts and more market momentum, according to a report from the National Bank. Despite a rise in new listings, active listings dipped slightly, indicating a complex interplay of market forces at work. Today I'm going to demystify the Canadian mortgage stress test, a crucial component for anyone looking to buy, refinance, or renegotiate a mortgage with a federally regulated lender. While some provincially regulated lenders might offer more flexibility, the stress test is widely used across the country to assess financial risk. This means that most homebuyers in Canada will encounter it at some point during their mortgage journey. But what exactly is the mortgage stress test? It's not a test in the traditional sense. Instead, it's a set of rules that major banks use to determine if you qualify for a mortgage. Given that mortgage rates fluctuate, the Canadian government introduced a minimum qualifying rate to protect both lenders and borrowers. This ensures that you'll still be able to afford your mortgage payments if interest rates rise above the rate initially agreed upon in your contract. So, how does this stress test work? When you apply for a mortgage, your lender will offer you a contract interest rate based on current market conditions, the details of your mortgage, and your credit history. However, to determine your eligibility, the lender will calculate your payments at a higher interest rate. This is to ensure you can make your payments even if rates go up. Currently, since June 1, 2021, the minimum qualifying rate is the higher of either your contract rate plus 2% or 5.25%. To illustrate, if you wish to borrow $400,000 with a 5-year fixed rate of 4.0%, you'd need to prove you can afford a mortgage payment calculated at 6.0%. While your actual payment would be significantly lower, this buffer ensures you can handle potential rate increases. The stress test was first introduced in 2016, initially applying only to insured mortgages, where the buyer's down payment was less than 20%. The aim was to create a financial safety net for borrowers who might struggle to make their payments if circumstances change, such as an increase in interest rates or a change in income. In 2018, the scope of the stress test expanded to include uninsured mortgages as well, affecting all buyers applying through federally regulated lenders. Over the years, the test has seen several changes, including adjustments to the qualifying rate and how it's applied. For instance, until June 2021, the stress test rate was linked to the Bank of Canada's 5-year rate. Concerns about its adequacy during the pandemic led to a decoupling, with a fixed floor rate now reviewed annually. A notable update occurred in late 2023 when the federal government lifted the requirement for insured mortgage holders to undergo the stress test again when switching lenders at renewal. Starting November 21, 2024, this will also apply to uninsured mortgages, allowing borrowers to qualify at market rates when renewing with a different lender. Despite these changes, borrowers refinancing their mortgage must still pass the stress test, whether they stick with their current lender or switch to a new one. The stress test effectively reduces the size of the mortgage you can qualify for, unless you can provide a larger down payment, which also impacts the type and location of the property you can purchase. There's no way to completely avoid the stress test if you're dealing with a federally regulated lender. However, provincially regulated lenders, like credit unions, might offer more lenient terms, although this often comes at a cost. Borrowers might also consider reducing personal debt or finding a co-signer to improve their chances of qualifying for a larger mortgage. For those looking to understand their mortgage affordability under the stress test, online tools like the Government of Canada's Mortgage Qualifier can provide valuable insights. These calculators help prospective buyers determine the maximum mortgage they can afford based on the qualifying criteria, offering a clearer picture before engaging with lenders or brokers. And that wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found this deep dive into the Canadian mortgage stress test informative. As always, stay tuned for more insights and updates on the ever-evolving real estate landscape. Thank you for joining me, and until next time, take care.